Welcome everyone to the US Corporate Tax Developments webinar in association with Tax Analysts. I'm Tom Reynolds. I'm the head of transfer pricing and M&A at Schneider Electric, a global specialist in energy management and automation. I also lead the Greater India tax team at Schneider. I'm a council member and VP of the Institute of Tax of Ireland, and I've over 25 years experience in industry. And prior to this role, I was head of tax and treasury for Calogemia, and prior to this, I was global head of tax at Carrie Group, PLC. Carrie Elliot is a contributing editor to Tax Notes International. She's the author of the series, The Tax Cuts and Jobs Act, a practitioner's resource, and has written on topics as diverse as healthcare, carbon taxes, VAT tariffs, trade agreements, money laundering, cross-border political activity, and tax accounting. Karen Frawley is president of the Irish Tax Institute. Karen is a tax partner in Deloitte and a member of the firm's international tax group. She has over 17 years experience advising multinational groups, investing in Ireland, the Irish-based groups, and outward investment. Benjamin M. Willis is a contributing editor for the Tax Notes Federal and Tax Notes International. He has worked in PwC's National Mergers and Acquisitions and International Tax Services Group. Ben has also served in the US government in the Treasury Office of Tax Policy, in the IRS Office of Chief Counsel, then as a senior corporate tax counsel for the Senate Finance Committee. Martin Sullivan, chief economist and contributing editor for Tax Analysis Daily and weekly publication and blog, is an expert in federal tax reform. Marty has written over 1,000 economic analysis for the Tax Analysis publications and is author of 2 books on the tax reform. He has testified before the Congress on numerous occasions. And for all attendees, if you have questions to ask, you can use www.slido.com using hashtag #USCorpTax, and we will endeavor to get to as many questions as time permits. I would like now to invite Marty to present his update on where we are now.
Sure. Thank you. Thank you, Tom. Yes, we have breaking news. And hello to everybody. Today, we're going to talk about the Build Back Better Act, the BBBA, which is very much a work in progress. It was originally proposed by President Biden in his budget, but since then, it's been much whittled down and much modified several times in the House of Representatives. The version we're going to focus on today is what passed the House of Representatives by a razor-thin margin, 220 to 213 on November 9th. So the bill right now is stalled in the Senate. And just to make our weekend more interesting, on Saturday, the Senate released a sort of a placeholder version, a snapshot of where they are right now. And let me just mention right off the top what the 3 noteworthy changes in that particular version were. The first, for our new corporate book minimum tax of 15%, the calculation of adjusted book income will now remove the fluctuations in value that occur in book income due to changes in pension reserves. And this is something that a lot of big corporations were insisting on. Second, the House version of the bill, the version that passed the House, had new interest limitations over and above what we have in current law. And those interest limitations would have restricted deductions in the U.S. to 110% of a proportionate share, where the proportionate share was basically U.S. cash flow over worldwide cash flow. Well, a lot of companies objected to this, so now they've added an alternative where you can use U.S. assets versus worldwide assets to determine the U.S. proportionate share. And Ben's going to talk more about this later. And then the third breaking change, and it might be of particular interest to folks in Ireland, is that in the original House bill, there was no no change to current U.S. anti-inversion rules. Well, Now there are numerical limits on the amount of ownership change that has to take place to be exempt from the penalties from Section 78, 74, and those ownership limits have been made more stringent. So the ability to invert into Ireland and other good locations has been removed. So that's just a quick news update. Just mentioning very quickly, please be warned, there will be more changes. Also be warned, this bill may not pass until calendar year 2022. And also be warned, this bill may not pass at all. It's in a very precarious position. But that's just the breaking news. Now for the more substantial stuff, we'll go back to Ben.
Thanks so much, Marty. Appreciate that. I'd also like to thank Tom for the introduction at the beginning, as well as the Irish Tax Institute and Tax Analysts for putting together this joint presentation. So I am going to start off after the breaking news, which for those of you who are reading the 1,200-page document over the weekend from the Senate, I hope you've had a chance to rest. And I think Marty hit the key points well. But for the comprehensive package that we're going to be talking about over the next hour, the House passed Build Back Better Act, we have a theme that we're going to see is consistent throughout a number of the provisions that we'll be talking about. And I think what we'll find in discussing that theme, which is financial accounting, is that it really expresses an understanding that the U.S. is attempting to collaborate with the world on creating minimum taxes and base erosion prevention thresholds and standards. And we'll see that there are 137 countries who are all aiming for this collaboration. And one thing about financial accounting is you could view it as the universal language that all of these countries can use in order to adopt an economic income. Now, we know that some countries have clearly defined thresholds for taxable income, and for those countries, you could certainly have a lot more complexity. And I know that's one of the biggest criticisms of some of these proposals. But at the same time, I think it's important to realize that there are 137 countries who are all trying to align. And the IFRS, GAAP, FASB are generally applicable to a broad slew of these countries who have adopted these standards. But as far as the complexity that they will certainly bring, it's important to realize that the collaborative effort is really there. Now, on some of these complexities, I just wanted to point a couple examples out that we'll get into later on in the discussion. The first is EBITDA, and we'll talk about that when we get to earnings stripping in Section 163 inside of the U.S. Internal Revenue Code. And we adopted in 2017 under the Tax Cuts and Jobs Act a provision that folks often refer to as having an EBITDA threshold or based on EBITDA. In fact, that adjusted gross income definition is entirely tax-based, based on the Internal Revenue Code, incorporates NOLs under Section 172, the 199 Cap A deduction, and is much different than what's being proposed under the Build Back Better Act, the House-passed version, and is found also in the Senate version under 163N, which would adopt a financial accounting threshold and incorporate a definition of EBITDA that is consistent with what companies around the globe are using for their financial statements. One interesting point about that provision is that IFRS, GAAP have no clear definition of EBITDA. And so there's going to be some uncertainty there. And whether or not we have a mirror tax system where the FASB rules and the GAAP rules and the IFRS are referring to tax principles for purposes of EBITDA to get a more defined threshold, or whether or not there's conflict within the tax rules themselves has yet to be seen. And so we could expect the possibility for lobbying for these other agencies that are providing these generally accepted accounting principles. And that's exactly what's been happening to the U.S. tax code over the last 100 years. I know many of you are quite familiar with that. So we could potentially see that replicated in other forms, notwithstanding that economic income is really the underlying theme of those financial accounting statements. So with that said, we will walk into more detail the provisions in the Build Back Better Act, but I just wanted to mention this theme that is consistent with the OECD's collaborative efforts to get as many countries in the world working together as possible. So I will hand it over to Marty.
Thanks, Ben. This slide is what I call my cheat sheet because I can't remember all these things that are going on at the same time. And on one sheet here, what I've tried to put down are what are the major business and international provisions in play in the US and also, of course, in the OECD. And we'll be discussing most of them today. There's the book income, minimum tax, there's the changes to the GILTI rules, there's the changes to the BEAT, there's the changes to the FDII, there are the new additional interest limitations, and a 1% excise tax on stock buybacks. And these are going to have at least relationships to Pillar 2, the income inclusion rule and the undertax payment rule. Really, there is no part of this act that directly impacts Pillar 1. One way of comparing these proposals is to look at the different thresholds. Some apply to big and some apply to small. And I think sometimes we delve too quickly into the details before we get perspective on this. So for the 15% minimum tax, this only applies to the very, very largest corporations with over $1 billion of before tax income. For foreign-based multinationals, the threshold is $1 billion worldwide and $100 million in the U.S. GILTI pretty much applies to everybody. The BEAT, more of a mid-sized provision. It applies to businesses with over $500 million in gross receipts. The FDII provision applies pretty much to everybody. The new interest limitations apply to companies with net interest expense over 3 years, averaging $12 million. Then we look at the excise tax on stock buybacks. Well, that was only going to apply to publicly traded corporations. And it's interesting to compare this to the OECD again, where we have this Pillar 1 provision that only applies again to the very, very largest corporations, those with $20 billion of gross receipts, and with rates of return on receipts in excess of 10%. And then the Pillar 2 provisions are sort of similar to our GILTI provision, just generally speaking, and there you need $750 million of euros to apply. The other way to compare these proposals or to think about them is to compare their effective dates. And the big news, the difference between what was originally proposed by the Biden administration and by the House, but did not end up coming out of the House, is that most, but not all, of the effective dates have been moved to 2023. So even though all this stuff is extremely complex, at least unlike last time with the TCJA, we're going to have a year to digest most of it and for Treasury to write regulations. The exceptions from 2023, if that is there are some BEAT changes that won't take place until 2024. The excise tax on stock buybacks will start in 2022, and where is it? Oh, the BEAT rate is going to change, I think, earlier. But the other thing to point out is, I think it's very important, is why did they move it back to 2023 in the House bill? And that was because folks were saying, oh, we don't want to get ahead of the OECD. Now the folks at the OECD are saying, well, we're not going to even be done by 2023. We may not be done until 2024. So, these dates are all in flux. But the good news is they're pushing them back. That's all. Karen, do you want to add anything to that?
Yeah, sure. I mean, just on the timing point, it is interesting. I mean, the OECD were due to release detailed model rules on both Pillar 1 and Pillar 2 in November. And again, it's expected that those rules might be published this week, but there is a school of thought that the OECD are waiting to see where the US tax changes go and if actually they do progress before the OECD detail is released. Another relevant timing point, I suppose for everyone to bear in mind is that the EU are quite firm in saying that they're going to publish a draft directive which brings the Pillar 2 rules into EU law, or a draft of it, on the 22nd of December. So a nice Christmas present for all of us. But with negotiations starting on that in a bit more detail on the 4th of January, with the expectation that that will be agreed before the French presidency elections in April. So that's quite a short, time frame. And I suppose it will be very difficult to see a scenario where the EU commit to implementing Pillar 2 rules without the US tax changes having progressed. So I think they are, very much interlinked, and there is, that standoff on who goes first. I mean, it is interesting, and I think you mentioned it, that there isn't any Pillar 1 type provisions in the US tax changes. And that's probably because Pillar 1 is arguably more politically sensitive in the US than Pillar 2. And, even looking, as you said, Pillar 1 is due to be implemented in 2023. Is that realistic? Only time will tell, but it does look like a very tight time frame. But I suppose what is helpful is, in the meantime, both the US and various EU countries have agreed a credit for digital services taxes that are paid in the interim. And equally, Canada, which had announced a new DST, have said that would be retroactive to 2022 if Pillar 1 isn't enacted by 2023. So there's still an awful lot to play out, but it is worth noting that if implementation slips, what we'll probably see is more digital services tax being enacted by individual countries.
Yes, it's very hard to see how Pillar 1 is going to pass in the United States. And it is funny how everybody else says, you go first. So everybody's waiting for everybody else to go first. And we'll have to see how that plays out. Who's up next, Ben?
I think this one's mine. So it's been noted previously that the odds of these bills passing are not high. They're not low, but this slide just basically says if none of this proposed legislation passes, what you see is what you get. This is current law. So this is what happens if nothing passes. As you can see, the beat rates increase after 2026. The guilty rates increase after 2026 because the Section 250 deduction takes a haircut. Same thing happens with foreign derived intangible income. The Section 250 deduction takes a haircut and the effective tax rate increases. So let's go to the next slide and we can see what happens with the Build Back Better Act. As you can see, the beat rates increase more quickly. That 12.5% rate in 2023 goes after 2026 under current law, and now it moves up to 2023. Similarly, once again, the guilty rate increases as the deduction decreases. Same with foreign derived intangible income. As a last point, we all thought it was very interesting that none of this proposed legislation offers adjustments to the current 21% U.S. corporate tax rate. So that looks here to stay. Now we can move on to the next slide. Ben.
Thanks so much, Carrie. And that was a a great segue into the 15% corporate minimum tax. I'm going to talk a little bit about how this popped back up into the Build Back Better Act, because to your last point, Carrie, we have settled in at a 21% rate. But first, let me just say that this is not the U.S.'s first attempt at utilizing a book income adjustment. In 1986, in the Tax Reform Act of 1986, we had the business on tax reported profits adjustment for the corporate AMT that existed from 87 to 89, and largely had goals that are similar to what I think are the focus of these proposals. So I want to go ahead and read off the legislative history to that provision, which says the provision will increase both the real and perceived fairness of the tax system, eliminate the highly publicized instances in which corporations with substantial book income have paid no tax, and further broaden the minimum tax base to approach economic income more closely. And so we've seen highly publicized instances that folks are throwing up over the past couple of years in support of this minimum book tax in order to minimize the disparities that have largely been allowed and endorsed by Congress as they've slowly incorporated benefits for taxpayers throughout the U.S. And so every so often we see this attempt for a reset to simplify some of the loopholes, I could call them, or some would say, when you have these lobbying efforts that are so successful and able to carve out certain provisions. And we'll talk about that more later on, including the GILTI tax in the OECD and how America seeks to exclude some of its provisions, and how this 15% book minimum tax may in fact not align with the OECD's 15% threshold. But getting back to the point, we first saw this in Biden administration's Treasury Green Book pop up again, I believe largely to align with the OECD's objectives. And then Senator Sinema objected to increasing the corporate tax rate beyond 21%, which was Carrie's last point. And so, notwithstanding this was not in the original Ways and Means draft, the House passed November 19th version added the 15% corporate minimum book tax back, and it was not modified greatly. It was left intact this weekend when we had Senator Wyden's proposals. There was a change for covered benefit plans, the book tax differences that happen largely for pensions and other employee benefits in order to eliminate some of the differences there. Next slide, please. So let's go ahead and just walk through the basic mechanics of this book tax so we can appreciate how it would be implemented and affect us. So the tax would be imposed in addition to the regular tax on U.S. corporations and foreign corporations with significant U.S. activities that have material book tax differences. Common differences for book tax are depreciation, stock-based compensation, and pensions. For applicable corporations, the minimum book tax would impose an addition equal to the excess of the tentative minimum tax over the regular tax plus the beat. The tentative minimum tax is the excess of 15% of adjusted financial statement income, and you'll hear that term a few times throughout this discussion, over the corporate AMT. Now, an applicable corporation is a corporation which, over the 3 years prior to the current year, has an average adjusted financial statement income greater than $1 billion. Or in the case of a foreign parented corporation, for international financial reporting groups with a U.S. subsidiary underneath, that U.S. subsidiary has to have an average adjusted financial statement income over $100 million, with the entire group over $1 billion. The effective date for these provisions would be for taxable years beginning after 2022. Next slide, please. All right, so a little bit more about adjusted financial statement income. That means the net income or loss of the taxpayer set forth on the taxpayer's applicable financial statements, as adjusted per the rules below. Applicable financial statements is defined with reference to section 451B3 and includes GAAP, IFRS, and other financial statements used to report to government agencies. Rules applicable to the groups of entities for treating them as one taxpayer are as follows. All persons are treated as a single employer under section 52A or B are treated as one person. A reporting group's adjusted financial statement is the taxpayer's adjusted financial statement. Consolidated group members shall take into account items on the taxpayer's AFS properly allocable to group members. And we'll see that allocable portion again later on when we get to 163 and some other similarities for the new 163N provision. And then corporations not included in the consolidated group other than CFCs shall take into account only dividends and other inclusions. In the case of CFCs, adjusted financial statement income includes the taxpayer's pro rata share of the net income or loss from the AFS of each CFC. Aggregate net losses do not reduce the AFSI, but may be carried forward. Next slide, please. For purposes of determining the AFSI, federal income taxes and creditable foreign taxes are disregarded. The corporate AMT foreign tax credit for taxpayers claiming tax credits under Section 901, the AMT is equal to the sum of the lesser of the pro rata share of the foreign income taxes taken into account in the taxpayer's AFS and paid or accrued by the taxpayer's CFC, or the product of the net income of CFCs included in AFSI and 15%. The amount of foreign income taxes taken into account in the taxpayer's AFS and paid or accrued by the foreign taxpayer. I know we're getting a bit into the details, but these slides and these definitions I think could be valuable as we move forward. So finishing up here on this last slide with respect to the 15% corporate book minimum tax. And I want to save a minute at the end for Marty, because I have a feeling, based on a discussion earlier, I want to mention the general business credits. But just at a high level, the corporation's AFSI may be further reduced by the lesser of the aggregate amount of the corporation's financial statement NOL carryovers, or 80% of the AFSI computed without regard to the NOL. Existing financial statement NOL carryforwards are permitted, but only for those incurred in taxable years ending after 2019. Disallowed NOLs may be carried forward indefinitely. The book minimum tax may be credited against the regular tax and the BEAT payable in future periods. And then before I switch over to general business credits, I just wanted to mention that the broad grants of regulatory authority throughout the Build Back Better Act represent a large shift in strategy compared to the Tax Cuts and Jobs Act, which had what many view as restrictive grants of regulatory authority. I think that largely encompasses the idea that Treasury is going to have to complete this legislation. Reconciliation legislation like the TCJA is quickly done and often doesn't have the time for full vetting or any legislative history like this legislation. And so making sure that some of the gaps that such legislation is certain to have are filled in so taxpayers can comply with the new laws is essential. And so these broad grants of regulatory authority are aimed at that. Now, for the final point, the general business credits here, R&D, clean energy, these may reduce the tentative minimum tax, but credits limited to 75% of the sum of the regular tax, AMT, and BEAT. So the big takeaway there is that these tax credits may reduce the liability and therefore affect the application of the potential 15% rate, if you want to look at it like that. Marty, did you have any observations on that last point?
Well, I just want to point out that a minimum tax that allows lots of business credits may not be much of a minimum tax after all. This bill is adding $300 billion in new energy credits. And of course, there's the R&D credit, low income housing credit, a whole bunch of other stuff. So a taxpayer may be in compliance with this AMT, but have an effective tax rate well below 15%, which, if I understand the OECD rules correctly, where they may not be so forgiving. And so U.S. taxpayers in compliance with this new corporate minimum tax may be subject to the income inclusion rules of other countries, where the U.S., basically our taxpayers in the U.S. are below the minimum, and they're subject to other countries' application of Pillar 2. So I think that's an interesting little twist. And it just reflects the tension with all of these minimum taxes where, on the one hand, Congress wants to give away tax benefits, in this case, particularly energy tax credits, but then they don't want them, they want to impose a minimum tax. Who's going to get hammered by this minimum tax are the folks with a lot of accelerated depreciation. It would be public utilities, of course, manufacturers. So, and the political pressure on Congress to make changes to accommodate them will be very great. So that's all I'll say.
I think that's a great.
Karen, you might want to mention something.
I mean, that's a fair point. These rules, while at first glance they look aligned to Pillar 2, they're not really. They're probably a lot more forgiving. So you're right. If the US companies are making payments to foreign jurisdictions, to related companies, it's likely they may fall into the undertax payments rules and will end up with additional tax in foreign jurisdictions. So yeah, I mean, that's potentially where you could end up from 2024.
Yeah.
I think
we can go to the next.
Marty.
Thanks. You want to go to the next slide? Well, I'll talk about the GILTI and the associated foreign tax credit changes. I'm going to roll 5 changes all into one because you got to roll all 5 into one to really understand what's going on. The first thing, of course, is that the effective rate on GILTI is going to change from 10.5 to 15%. That's not taxpayer favorable. The big kahuna here, the big change, and in alignment with OECD's income inclusion rule, is that we want to go to a per country calculation. And this is complexity on top of the complexity we already had in the TCJA. So mind-numbing is the adjective often used to describe it. The third change, which is taxpayer favorable, in the TCJA, tax credits associated with GILTI were only 80% creditable. That's going to be increased to 95%. Or to say it differently, the haircut has been reduced from 20 to 5%. Another unfavorable change is that what the OECD calls the substance exception, what we call the QBI exception here in the U.S. Under the TCJA, GILTI income from a CFC, which was equal to 10% of tangible assets, was exempt from U.S. taxation. And basically, this bill would cut that in half, reduce it to 5%. And then finally, and this is another very significant change, the drafters kind of screwed up when they wrote the TCJA. Didn't quite understand the interactions of the GILTI with the foreign tax credit limitation. And what the end result of all that was that, ironically, this minimum tax-like provision ended up imposing significant tax on companies that had effective foreign rates above the minimum tax rate. Now, if you roll all those together and you do all the algebra, this is the bottom line, and it's highlighted in blue here. The tested income of a CFC, the first that amount that is equal to 5% of QBI, that is 5% of tangible assets, will be exempt from U.S. tax, and then there'll be a U.S. top-up tax on all the income above 15.8%. So if you have a tax rate of 14%, U.S. tax will be 1.8%. If you have a tax rate of 16%, you're in the clear. But remember, this all has to be done on a per country basis. Next slide, please. But there's more. One tax favorable change is that the branch basket would be eliminated. So instead of having 4 major categories of foreign tax credit limitations, we only have 3. Now, the rest of the stuff I like to call timing changes. And all of these, most of them, are reasonable and favorable for taxpayers. Under current law, you're allowed a 1-year carryback of foreign tax credits. That would be eliminated, and that's taxpayer unfavorable. But the big problem with GILTI was you weren't allowed any carrybacks or carry forwards. And the drafters have seen the light, and then starting in 2023, you'll be allowed a 5-year carry forward of foreign tax credits. And in 2020 and 2030, if we ever get there, we'll get a 10-year carry forward. And then also there were other problems with the timing issues in the TCJA with relating to GILTI. Tested losses could not be carried over. That's been changed. What else was there? There was the foreign tax credits associated with loss companies was not allowed. That has been changed. The way I like to think about it in my simple mind is that the TCJA allowed you to average geographically all over the world, but didn't allow you any timing averaging. And now this Balanced Budget Better Act would just reverse that. Now you can't do any averaging geographically. You have to keep everything in bounds per country, but you're given a lot of flexibility over time. And then just quickly to the last slide, please. I mean, the last GILTI slide. Doing per country calculations isn't going to be easy. It's going to be extremely difficult. One commentator said it was like the TCJA was like taking high school algebra, and now this BBBA would be like skipping first year calculus and going right to differential equations. And I could never understand differential equations, so I can relate to that. This is just going to be a tremendously difficult issue. As Karen pointed out, I believe she's being very generous. She says they're waiting to see what happens in the U.S. Congress. I don't know if they've even figured it out yet, what exactly they're going to do, because the most complicated thing is to figure out how you're going to calculate an effective tax rate on a per country basis. Obviously, they're going to leave a lot of this to regs. The good news, or sort of good news, is that in 2020, the IRS, the Treasury Department, issued proposed regs on a high tax exception. And in that high tax exception, to do that high tax exception, you must calculate effective tax rates on a per country basis. So if anybody wants a preview of how this might be done, I would suggest looking at those proposed high tax exception regs in 2020 to get a flavor of what would be involved in doing per country calculations. And just to get back to Ben's original theme, heavy reliance on financial accounting. And the other theme I will mention is perhaps these numbers do not exist in your current business practices. So guess what? You have to make them up. You have to make them up consistent with financial accounting practices and with the arm's length method. So you can't underestimate how complicated this is. There's also differences in the calculation of QBI and the QBI in the United States and its equivalent or its parallel, the substance exception rule in the income inclusion rule. I won't go into detail on that now unless Karen wants to or it comes up later. So we can move on, or Karen can comment.
All right, I'll move on into the base erosion and anti-abuse tax. So there's been some changes. Well, there'll be some material changes, quite a few of them. Some are favorable, some are not. But the good news is it's kind of straightforward, so this shouldn't take long. But we'll go through current law really quick and just review the BEAT formula. Basically, the tax is 10%, raising to 12% in 2026 or even higher than that if this bill passes, times the difference between a modified taxable amount or a regular taxable amount, regular taxable income. Basically, the modified taxable amount is taxable income that's increased by base erosion tax benefits. And base erosion tax benefits are deductions for base erosion payments, which are deductible payments made to foreign related persons. Related meaning 25% of voter value generally. It's a little more complicated than that, but that's what you should remember. The base erosion percentage is a fraction where the base erosion payments as a percentage of all of the deductions to see if you can get to the base erosion percentage, which is a de minimis threshold for being subject to the BEAT, but we'll get to that. The regular taxable amount is reduced by tax credits. What that does is it increases the difference between the modified and the regular, and that's unfavorable because it increases the difference dollar for dollar by the amount of the credits. The BEAT applies to applicable taxpayers, and these are corporations that have over $500 million in average annual gross receipts for the prior 3 years, and that base erosion percentage of 3% or higher. There's a couple of tweaks for banks and securities dealers. They have a 2% base erosion percentage and their BEAT is 1% higher. So let's move to the next slide. So first, as we discussed previously, the Build Back Better Act increases those BEAT rates. It also eliminates the 3% base erosion percentage de minimis threshold for applicable taxpayers after 2023. That's unfavorable. Probably most importantly is current law allows cost of goods sold to be not a base erosion payment, but this bill takes some of that benefit away and conceivably allows royalty payments embedded in cost of goods sold to count as base erosion payments to the extent that it exceeds some of the foreign payees' costs. It's a little more complicated than that, but it's unfavorable because it messes with that cost of goods sold opportunity. The NOL calculation is a little more unfavorable because it doesn't include base erosion tax benefits. It does not reduce that regular taxable amount or regular taxable income by tax credits. And it also allows the use of business credits against the BEAT. So both of those are favorable. As Karen pointed out earlier, payments to related foreign persons that are subject to a 15% foreign effective tax rate are not base erosion payments. Those are favorable, and note that that is a cliff. So if you hit that 15%, you either win or lose. The next modification is applicable taxpayer status after 2021 remains in place for 10 years. That's unfavorable because if you have some sort of really unusual transaction in those 10 years, you could get hit with a BEAT. So at the end of the day, most U.S. parented corporations won't be subject to this modified BEAT, and foreign parented multinationals will be subject to the BEAT only if they exceed that 500 million threshold of U.S. receipts. As a last point, this BEAT, especially as modified, looks a little like OECD Pillar 2's under-tax payment rule for under-tax payments to related foreign persons. So now we can move on to the next slide.
Oh, okay. Foreign derived intangible income. That is our version of a patent box, but most people don't like me to say that. But at any rate, what the bill would do would be to tighten the benefits available under the FDII, and it mainly does that by increasing the rate. As Carrie pointed out at the beginning, if there is no change in law, the effective rate of 13.125% would increase to 15.8. If there is a change in law starting in 2023, the rate would increase to 15.8%. I'm sorry, to 16.4%. There's also another change which would take place immediately, which is in the mechanics of the calculation of the FDII, they would exclude income from passive rents and royalties, and so that will generally reduce the FDII benefit. This is probably the simplest of all the changes. And while we're talking about R&D or intangible stuff, it's worth mentioning that in the TCJA, in a ridiculous move, we proposed beginning in 2022 to instead of expensing research, to amortize it over 5 years, and that in this bill has been delayed until 2026. So that's all I want to say about FDII for right now.
Thanks, Marty. I'm going to make two side comments. One, I noticed both of your slides, Marty and Carrie's, listed out unfavorable and favorable consequences. I really like that. I thought that was helpful. If folks don't realize, the minimum book tax and this 163N limitation on interest, they're all unfavorable for taxpayers. So just wanted to clarify that. And I couldn't help but think about the last time I spoke for an Irish Tax Institute panel. And my theme is America shameless? And I was reminded of that when Marty mentioned FDII is the equivalent of a patent box. And what I think it's important to recognize is, notwithstanding any suggestions to the contrary, all countries are looking out for their sovereign interests. And so to the extent that certain industries are excluded, we talked about general business tax credits earlier being exempted from the minimum tax. Could that be tech? Could that be pharma? Could that be clean energy? Reducing these taxes, the FDII. These are all examples of countries really aiming to protect their own interests. And so I just thought I'd mention that point before diving into 163N on the interest limitation. So for the TCJA, we had a new interest limitation that replaced the old 163J, and it is a limit on the net interest expense. And that limit is generally 30% of adjusted taxable income. People refer to this, and I mentioned this earlier in our overarching theme, that adjusted taxable income is referred to as EBITDA. Again, EBITDA historically is viewed as a financial accounting concept, notwithstanding there's a lot of flexibility under it because it isn't defined clearly under IFRS or GAAP or FASB standards, and is merely designed to provide an understanding of the economic performance and success of a corporation. But the fact that it's being utilized in 163J with a very specific definition based on adjusted taxable income, in contrast to the EBITDA that is being proposed as a definition in 163N. And I'll just read that real quickly. This comes directly from the Build Back Better Act, House proposed version. The term EBITDA means with respect to any reporting year, again, we're focused on the reporting groups, financial reporting group, earnings before interest income and interest expense, taxes, depreciation, depletion, and amortization. That difference is large because there's a lot of room, in my opinion, for how that could be interpreted. Are we intended to distinguish it from the EBITDA that's used from 163J? I believe the answer is yes, and I believe the interpretation of how that is determined on financial statements could greatly impact the calculation and the limitation imposed by 163N. I suppose I should say that both of these limitations apply together, and so it's really whatever one limits the most interest. But at the same time, I think there's planning under both. So let me go ahead and define the actual limitation under 163N. We also have a net interest limitation for deductions of a specified domestic corporation that is a member of an international financial reporting group to the extent it is disproportionate based on U.S. versus worldwide EBITDA. In other words, there's interest stripping going on. The U.S. government believes the U.S. is taking advantage of too much deduction versus what's occurring in the overall group. There's exceptions for S corps, RICs, REITs, small businesses, and as Marty mentioned in his outline earlier, there's a $12 million net expense on the 3-year average. That's the threshold for when the limitation kicks in. It applies to both U.S. and foreign parented multinational corporations. It's based on the data from financial statement on books and records. And the limit applies a ratio of net interest expense to EBITDA is higher than the U.S. In the U.S. than for the group, which is really what I was saying earlier about the interest stripping. You're getting more deduction in the U.S. Than the whole group is taking. So an international financial reporting group is any group of 2 or more entities that includes at least one foreign corporation that is engaged in a trade or business in the U.S. and at least one domestic corporation, foreign corporation included in the same applicable consolidated financial statement for that taxable year. A consolidated financial statement generally means, for this purpose, a statement made on the basis of generally accepted accounting principles, international financial reporting standards, or other comparable method of accounting, and which is provided to the SEC, shareholders or creditors, or to government agencies. Next slide. A specified domestic corporation's current deduction for interest expense is limited to the allowable percentage times 110% to the specified domestic corporation's U.S. tax interest expense. And again, just to compare that to the 30% of adjusted gross income or taxable income from the 163 limitation, the one that limits the most interest from these 2 thresholds will apply. So allowable percentage times 110% of the specified domestic corporation's net interest expense. Let's talk about the allowable percentage. It's the domestic corporation's allocable share of the group's reported net interest expense based on financial statements, divided by the domestic corporation's reported net interest expense. And then that allocable share is measured by comparing the domestic corporation's EBITDA to the group's EBITDA, to the financial reporting groups, the international financial reporting groups' EBITDA, both as determined under the reporting, the financial statements. Treasury has broad authority to include or exclude any corporation as a member of the International Financial Reporting Group, and there's a specific mention of a 20% owned corporations in that language. Treasury may also treat interest income of a CFC, which is subpart F income, and any related interest expense of the CFC as income and interest expense of a domestic corporation. Section 163N would apply in addition to the general disallowance under Section 163J. Section 163O provides an indefinite carry forward of disallowed interest expense. Like 163J also, no carry forward of the excess limitation, which is really if the taxpayer's limitation amount exceeds their net interest expense for the year, the benefit of that excess limitation cannot be carried forward. And again, that's the same as 163J. Sections 163N and O would apply for calendar year taxpayers effective after 2022. And Just thinking about the revenue estimates for 163N, I think it's important to take into account that 163J, our current limitation, is being reduced from EBITDA to EBIT, which will be a unfavorable, to borrow a term from Marty and Carrie, to taxpayers beginning in 2022, since the depreciation and amortization certainly accounts for a lot of that taxable income. So I don't know if Marty or Carrie or Karen would like to add any additional thoughts on this interest limitation.
Well,
No.
just to clarify,
I do know we've questions that have come in, particularly on this. So, Tom, I don't know if you want to take those.
Yeah, I would like to. The first question I'd like to ask: what are the practical implications for businesses of having to assess the applicability of tax measures such as the GILTI and the OECD Pillar 2 proposals on a country-by-country basis?
That's a good one.
I'm sorry, Tom. I just didn't hear that properly. I'm sorry.
What are the practical implications for businesses of having to assess the applicability of the tax measures such as the GILTI and the OECD Pillar 2 proposals on a country-by-country basis?
Yeah. Well,
I mean, I can probably start on that, because I know, Marty, you had touched on earlier on the GILTI part, and really the complexity, even from a mathematical perspective, of trying to figure out, how you look at a GILTI on a country by country basis. That's going to be the exact same on a Pillar 2 basis as well. So, I mean, realistically, an awful lot of complexity coming down the road. So, really something that organizations need to start thinking about their systems and how they line themselves up from that, how they potentially model what those changes look like at this point, and really if there's anything they need to do to lessen the impact of both GILTI and Pillar 2 on their overall ETR.
Thanks, Karen. Maybe one last question. Is there any exemptions from the ATM? Was one of the questions that has been raised from our US colleagues. Maybe you can comment on that, Marty or Ben?
Yeah, I can mention it
exemptions.
briefly. So this relates to the 15% corporate book minimum tax that we discussed earlier. I think one of the largest exceptions from this massive tax regime is based on the $1 billion threshold that'll be applicable going forward. And so this is only going to pull in, it's estimated, between 100 and 200 corporations. But there are certainly other exceptions in the provision for small business corporations. Obviously, if they're under $1 billion, they likely fall underneath that, REITs, RICs, and some other exceptions. But just generally, I think it's important to recognize that less than 200 corporations will be hit by the new 15% book minimum tax.
It's interesting. I will ask one more question. Does the panel have any thoughts on how the GILTI will coexist with the GLOBE rules under Pillar 2? And I suppose that the biggest question from that is, what does the panel think might happen if the two measures are not fully aligned? Where do you think we will end up going?
Well,
go
ahead, Ben, please. Go ahead.
I was just going to say that the U.S. is currently hoping to have the GILTI excluded or be exempted as a historical qualifying regime for Pillar 2. But it's interesting that the U.S. is pushing for some of these exceptions because, in my opinion, it raises the question as to whether or not other countries should be doing the same, should be advocating for current regimes and other provisions to be granted this kind of universal pardon from this Pillar 2's minimum tax. Marty, did you have any thoughts you wanted to share on that?
Well, you're just being too nice. U.S. firms are demanding that GILTI be OECD qualified. But at the same time, as you point out, the U.S. is steering GILTI, or somewhat haphazardly, towards the OECD. But on the other hand, what are we steering toward? Because we really don't know exactly what the OECD is going to do yet. And again, it's this game of chicken. Everybody's looking at what everybody else is doing. So it's very hard to say. What I would guess is that this process is going to just drag on for many years, where we're going to iterate between individual governments moving toward or away from OECD, and then OECD itself changing its standards. So it's going to take a little while for this to settle down.
And Karen, any final comment from you on non-alignment from an OECD and a EU perspective?
Yeah, I mean, nothing probably that hasn't been raised already. I mean, it is a difficult position, lots of modelling to be done, really working through the detail. I suppose it'd be interestingly, hopefully we will get the detail of Pillar 2 at some stage this week. That would allow us to assess that point in a bit more detail. So probably a case of watching the space and the news both this week and into the new year.
I think we're all waiting for a very exciting Christmas present from the OECD. I'd like to thank Marty, Ben, and Carrie and Karen for a very informative presentation, which shows there's a huge amount of potential changes coming down the tracks. And I think what it really highlights in the last question is that we have a huge amount of uncertainty as to where this will go, given that where everybody seems to be waiting for the other to react. So it should be a very interesting few months. I would like to also thank the attendees, and please ask attendees to complete a very short survey about the event, which will pop up shortly. Thank you all very much.
Thank you.
Thanks,
Have a good day, everybody.